Ever wondered who really controls the Indian stock market? Well, let's pull back the curtain and introduce you to the puppet masters of this intricate performance. The stock market, a bustling stage where the drama of financial growth and losses unfolds, has two key players pulling the strings. These are the institutional investors, the big guns of the financial world, and they come in two types: foreign institutional investors or FIIs and domestic institutional investors or DIIs. These are not just your average investors. They are entities like mutual funds, insurance companies, pension funds, and banks. They're the ones with the power to make or break trends, to drive the market up or bring it down. Their moves can sway the fortunes of millions of small investors. Now let's dive deeper into what these institutional investors are and how they influence the stock market. First, we have the foreign institutional investors or FIIs. These are entities from outside India, such as hedge funds, insurance companies, and pension funds that take a keen interest in the Indian markets. They are significant players due to two main reasons. Firstly, they infuse foreign capital into our markets, thereby bolstering our economy. Secondly, given the sheer size of their investments, they can significantly influence market trends. However, this influence can be a double-edged sword. When FIIs pour in massive amounts of money, our markets thrive, reaching new heights. But if they decide to withdraw their investments suddenly, it can cause market volatility, leading to sharp drops in market indices. This unpredictable nature of FIIs can sometimes make our markets resemble a roller coaster ride, full of thrilling crests and terrifying troughs. So while FIIs can bring prosperity, they can also bring unpredictability. On the other side of the spectrum, we have domestic institutional investors, or DIIs. These are Indian entities like mutual funds, insurance companies, and pension funds that play a significant role in the stock market. They are the sturdy pillars of our market, often investing for the long term. Unlike their foreign counterparts, DIIs tend to be more stable investors. They're not as easily swayed by short-term market fluctuations, and their presence can often provide a counterbalance to the volatility brought on by foreign institutional investors. But don't be fooled. This doesn't mean DIIs are any less important. In fact, their role is crucial. By investing in the Indian stock market, they channelize the savings of the public into productive investments. They are like the steady hand guiding a ship, ensuring that even amidst stormy seas, the Indian stock market remains on course. So while DIIs may not bring the flashiness of foreign capital, they provide a steady hand guiding the Indian stock market. So we have the flashy FIIs and the steady DIIs, but who's more important? Well, it's not a competition. Both these players have unique roles in the grand theater of the stock market. FIIs, with their vast resources and global perspective, bring in foreign capital. DIIs, on the other hand, stabilize the market with their long-term investments. Together, they create a balanced ecosystem, driving growth and stability. In the grand scheme of things, both FIIs and DIIs are key players on the chessboard of the Indian stock market, each moving in their own ways to checkmate the market volatility.